Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week Charisse and I sit down here and we talk through some of the issues of retirement, but we have a little fun while we're doing it. That's why we call this show Retirement Coffee Talk. Charisse, how are you doing today?
I'm doing fantastic. Just trying to figure out what to do with the kiddos over the summer. Mm-hmm. And my daughter, she's going to do a UF volleyball camp.
Right.
And we're trying to get into this band camp also. That one we're a little late on. And then Eli doesn't want to do camp. So I'm thinking about doing Camp of Mom and making it really hard on him. So he goes out and tries things. They've been waking up late and going to bed late. Mm-hmm. And I'm like, okay. So after a couple of weeks, the parents have to get regimented. So I told him, hey, Eli, we're about to get tough Camp of Mom here, and we are going to be dialed in. I'm going to have a schedule for you hour by hour. He's like, no. And I was like, we're going to do a little studying and a little work to keep up with our studies too. Mm-hmm. He went, no. So I'm thinking maybe he'll want to go try one of the camps if that's the case. So you gotta be tough on these kids. They'll run all over you.
I love it. All right. Well, last week when we were talking, you mentioned that there was a lot of talk about SpaceX. It was the biggest IPO that has ever done in the history of the stock market. Tell me how that all turned out, because it's interesting to me. I kind of equate that with a younger investor, somebody who has a stockbroker that they're going to call and say, hey, get me in on that IPO. Do retirees and people getting ready for retirement, are they making those calls to you?
We only got about, 8 calls to buy into the SpaceX IPO. I'll be honest with you. I thought we'd be getting a whole lot more, but only about 8 people. So we got them in. Mm-hmm. And you know what it is? I just think that people at Zinnia Wealth specifically, we have the plan. They have their different risk buckets or moderate buckets, their safe money buckets, and they're not out chasing the next flashy item anymore.
Right.
And so they're happy with their income, they're happy with their returns, and they're not willing to chase the superstar stock like they did when they're 30, 40, and 50 to potentially have a big loss in it. And I just think a lot of retirees they're kind of out of it. They're like, I'm good. Yeah. I had my time in that era where I did that and we did well. Now I just want to make sure my checks come in, make sure I'm getting the return that I need to keep up with inflation and, leave a legacy. So we just didn't see much of that. And I just certainly thought with SpaceX, we'd have hundreds of calls, but no, we didn't. I'm like, okay, well, everybody likes what we're doing. So that's good news for us.
Exactly. There's a lesson there that all those headlines, sometimes the splashy headlines that we see, sometimes they don't really affect us and maybe shouldn't affect us, but it's good to have somebody on your side, Charisse, that you can bounce that off and say, hey, should I be in on this or should I tiptoe into this? It's a good lesson right there. Well, we're going to move into what we do here best, I think, and that is talk about retirement and some of the issues that people have. And, it's pretty common, as I use the word tiptoe, for people to tiptoe into retirement. It's kind of like walking on rocks. When you're barefoot and you're walking on rocks and you're hoping you're hitting the smooth ones, you don't want to hit the sharp one. That's the way some people walk into retirement, because they don't know if they can spend and they don't know if their money's going to last. And, Charisse says, my job is to give you that kind of confidence. But here's something that came from Morningstar that I thought was pretty interesting that just kind of piles on that particular thing. And that is 70% of retirement plans that fail in the first 5 years of retirement. So that makes people go, oh, gosh, I don't want to spend too much. They get wide-eyed like that. Why do you think that is, Charisse? Is that just people that don't have a plan and they just kind of charge into retirement, and then 5 years in they go, holy cow, I'm spending more than I thought? What do you see?
Mm-hmm. So I see 2 versions of this. I see 50% of people where they're spending too much, and then I see 50% of people where they're not spending enough. Mm-hmm. And what happens with the people who don't spend enough, they don't have a pension. They typically only have a Social Security, and they're worried about running out of money. Yeah. So they spend less when really they could be spending more. And the other person doesn't budget very well and is very loose with their money, and they start spending a whole lot because they're thinking, oh, we're going to make an average of 10% a year for the next 30 years in retirement. And what happens is sometimes there's a market drawdown, right? That roller coaster ride, maybe it's 10%, 20%, but you're still taking money out. And it hurts your portfolio, because if you lose 10% this year, you have to make 11% to get to even. And the problem with all that is that if you're taking money out at the same time, it's like a double negative. And then it takes even longer. So you shouldn't be taking money out of the stock market when it goes down. So those people don't stop. They just keep taking it.
Got it.
And so we see, think what happened 2 years ago. Market went down 18%. And, it took 18 months literally to recover. So are you pulling money out every month during that time period when it's going down and recovering? That is a painful, hazardous domino effect. And so 5 years later, people were like, well, I'm not exactly where I thought I would be. Right. And if they would have had another bucket, they were pulling income out during the roller coaster ride, well, then they wouldn't have seen such a big hit in their portfolio. And the recovery time would have been much quicker and they would have had their equivalent dollars. And so it's called sequence of returns risk, Randy. And it is the returns you receive the first 5 years of retirement. So you have to be extra careful those first 5 years. But I don't want to scare people. The thing is, you just need a plan, a written plan. You need to see it. You need to see that withdrawal strategy. What buckets are we going to pull out of? If the market goes down, do we shift gears? If the market goes down 30%, what is our exit strategy? Do we even have one? And really build that out so people can see it. And then on top of it, add that income plan where it's an inflation adjustable income plan each and every year so that you can keep up with inflation. I had a client who came in and said, hey, inflation's kicking my rear, Charisse. I actually need to really up my income. We pull up their income plan. We created. I'm like, well, you're supposed to be taking this much. And so we're just off a little bit. So let's up your withdrawals. And she's like, oh, that would be helpful. Right. And so it's just ongoing maintenance of a portfolio and an income plan and that investment strategy. And most people don't know where to pull money out, Randy. That's the most confusing part. They're like, what is this withdrawal strategy? Like, I really don't know. Do I pull it from my taxable bucket, my tax-free bucket, my tax-deferred bucket? Do I have to do this Roth conversion thing? Does it make sense? Am I going to pay more taxes in the future? All those questions. And that's what we unravel here at Zinnia Wealth is where are you at? Where are we going? And how do we do it more conservatively than what your expectations are and still reap the reward that you deserve?
Well, this is one of the things that many people struggle with as they get into retirement if they don't have that income plan, that spending plan, that withdrawal plan that Charisse talks about. So if you're in that category and you're kind of tiptoeing into retirement and you see a big balance there right now and it looks really good, what is it going to look like 5 years from now, 10 years from now, 15 years from now? Let's just run those numbers. If you have your own plan or you have a plan that's set right now and you're nervous about it, come on in. Let's get a second set of eyes on it. Let Charisse run those numbers. If it's just for the first 5 years, the next 10, the next 20, let's get it done. 833-368-3680 is the number. 833-368-3680. It's a no cost, no obligation look at your retirement. Let's do the math on your retirement. See if there's going to be any problems in the future. 833-368-3680 or use the website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. Just click on that. Charisse, there's a lot of different kinds of people that come to see you with a whole bunch of different kinds of ways that they want to retire. A person who goes into retirement with a business, they want to sell their business in order to power their retirement. That brings on a whole new group of issues to deal with. There are 2 to 3 million baby boomers that own small businesses. They employ 32 million people and generate $6.5 trillion a year to our economy. They are very, very important, and they need some special treatment when it comes to retirement planning. Charisse, somebody comes in, my business is going to power my retirement. What's my next step? How does that conversation go?
Yeah, so we get a lot of people like that, and we have a broker that helps them figure out the value of their business and helps them sell the business. People sometimes come in the final hour where they're just done, but then it could take a couple of years, and you can't be done because if you sell the business, they might even want you to work a year or two. This is happening with my clients right now, and most people, when they're done in their 60s, they're done.
Yeah.
And they're like, I got to do this for 3, possibly 5 more years, possibly. So that succession plan is really important. And coming in 5 years before you think you're going to retire, you might not even know. You might say, hey, I'm going to work till I'm 65 and run this business till 65. And you could be 55 right now. I'm going to tell you something. That doesn't usually happen. I bet by 60, you're like, I want out. You might be there right now. So having those conversations with an advisory team that actually understands succession planning and the broker dealer type of deal when it comes to helping you sell and get that valuation. 10 years ago, I have a great example. A client came to me and says, I just want to sell this business, Charisse. I was like, okay, great. And actually, I'm thinking of 2 at the moment. And one of them was a plumbing business. And they made easy all day long. They netted like $250,000 a year, right? These are the next millionaires, by the way, because of AI. So good businesses to own. Well, he couldn't get anyone to buy the company. So you know what he did? He just retired.
Just dissolved it?
Dissolved it.
Wow.
And he could have all day long got a really good multiple on it. But he just tired of working, just was ready to go. And he's like, oh, I just don't want to deal with this because I have to train whoever it's going to be. And that's going to take 2 more years. I had another client who had another big, not a big company, but a printing company, and they did the same thing. And so I've watched it happen and I'm thinking, this is money. Like this, at least get $1 million out of it or $500,000 out of it. But when people get there to their wits' end, Randy, and they're just like,
I'm just
done. Worth that chase anymore. And so a lot of these people clearly have saved enough money that they could retire in their dollars. But you're saying goodbye to a business that you have built, these companies they had built over 30 years, and just saying, oh, never mind. I'm just not interested. So instead of getting wore out and tired, come talk to us so we can help direct traffic before you lose, because that's a big investment you lose. Think of the interest rate. That's an interest rate return. You have $1 million and you get an interest rate every year to get it to 1.5 million. That doesn't happen overnight. So again, more money for legacy, more money for you, more money for long-term care. And let's work on that plan for you, because I hate for you to just lose it.
There's a lot of different ways to go about it. My neighbor right across the cul-de-sac, he owned a Service Master franchise, right? And did it for years. And matter of fact, did a little work on my house when the tree fell on my house. And so what he did was he found somebody who wanted to take his franchise, but he couldn't take it all at one point. He couldn't take it all, in at one purchase. So he said, I'll work for you for 3 years. You pay me a salary. You also pay me part of what the business is worth, and in 5 years we'll be done. And he's done with that 3 years now, so now he's just getting paid. So it's kind of an easing his way out. So it doesn't always have to happen where it's just pay me and I'm done. That'd be great. But there are other creative ways to do that. Have you seen anything like that happen, that people kind of ease their way out?
Yes. So some of the deals that we've helped get done, it would be just like you said, a 5-year draw. Some people want to do a 10-year draw. Let's say they can't find a buyer and the buyer says, hey, I can't do 5 years. That's too much money up front, but I can do 10 years. A lot of these retirees don't want to do 10 years because they're not even sure these companies, because they can manage these companies for 10 years and they lose their money. So they'll take a lower price to get that 5-year deal, 2-year, 3-year, 4-year, 5-year deal. So that's typically what we see. So if your business is worth $1 million, that would over 5 years, you'd get 200,000, right? And there's other things you can plug in to get the deal if you don't want to work and you just say, hey, well, I want a little bit of the profit too. That you can wiggle in lots of things. There's
a lot of discussion to be done there. And that is a very unique way to approach your retirement. You're going to need some special care, a customized plan for that. So to sit down with Charisse and talk through all of those options and what looks good out there, and don't let it go to the last minute. If you see this happening 2, 3, 4, 5 years from now, come on in. Let's have the discussion right now. Here's the number, 833-368-3680, 833-368-3680. It's a no cost, no obligation look at your retirement. Really, it's just sitting down and having a conversation. 833-368-3680, or use the website ZinniaWealth.com, ZINNIA Wealth.com. Hit the gold box and you'll be on your way. Charisse, that is all the time that we have on this one. I will give you the last word.
Well, as usual, live by design and not by default. And we'll see you here next week.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.